let's get started. First of all, thank you very much for joining in today. Those of you who kind of attending for the first time, I'm also gonna touch base on how we're gonna move forward with it. Those of you who have attended all the three webinars, thank you very much for attending it. I hope you found it helpful. So this is a part three webinar. So we kind of did the whole webinar series on the year end close. This is the part three, the last one. Just a just touching base on the housekeeping items. We kind of recording this webinar. If you guys have any questions in between, feel free to leave your questions in the chat. I do have my colleagues on the call who is gonna answer your questions, and we'll also be distributing all the materials, the checklist, and everything once we are through with this webinar series. All right. Just a quick introduction. I'm Hardik. I'm one of the founder at Xenett. I'm also an accountant with about 15 years of experience, and we created Xenett to solve our own problems, right? So just as you guys know, Xenett is an intelligent cleanup tool that connects with QuickBooks Online, finds all different kinds of errors, and allow you to close your books pretty quickly. So as I mentioned, this is a part three webinar. In the first and second part, we touch base on what are the cleanup areas that we need to touch base like before we even start working on the year-end close. Then we one by one touch base on every single balance sheet accounts and we discuss as to how we kind of review them. In today's session, we're going to be touching base on the last remaining points, that is the payroll liabilities, the equities, and then profit and loss review. Now, even before we actually start talking about payroll liability and payroll clearing, let us just first of all understand what kind of different payroll liabilities accounts that we generally see on balance sheet. At least these are the accounts that I have dealt with, and I've seen people getting confused with these different kinds of payroll liability accounts, right? So for that, we first need to understand how the payroll is being recorded, right? So mainly, I have dealt with these four kinds of accounts. Number one is a payroll clearing account, which is more of a payroll liability account, right? For that, I'm gonna open up the balance sheet. I'm gonna open up the ledger for the payroll clearing. I mean, I've seen people using different naming conventions like payroll clearing, payroll liability, whatever you call, right? But what we generally do here is that whenever we record the payroll, we obviously on one side we generally book the general entry, and then one side we have expenses, and then on credit side we have the liabilities, right? So there is one entry that we generally record, which is on the liability side, and then whenever the payroll is paid, that's when we book the payment entry. So ideally, we would generally expect to have offsetting entries like 1250, 1250, 1320, 1320, right? So typically this is what generally happens if we are using more of a third-party agency like Gusto or ADP or Paychecks, right? So if we say the expectation from this account that ideally we should expect only the balance that should eventually get paid in the next month, right? And it all depends on how frequently you are paying your payroll. If it is weekly, then obviously you would expect that the last week's payroll balance should be the balance of this account, right? If it is monthly, once in a month, then accordingly you can expect. So the whole purpose of reviewing this account is to make sure that whatever balance that we have in this account should represent the last payroll's balance, right? So in this case, obviously, I kind of can see that typically we can see there is one entry for recording the liability, there is one entry for payment. Likewise, we can see the trend. However, we can see one entry, we can see the difference of 500, and this is like an additional entry that is recorded here. So now all we need to do, we need to then find out that what are those transactions that are causing differences here, right? Sometimes we have seen that if the transaction is miscoded, that might be throwing the balance off for payroll clearing accounts, right? So ideally, the expectation should be that the latest payroll, which ideally should get cleared or paid in the next month, should represent the balance of this account, right? So again, the idea is to find out those transactions which is causing the differences, and then we need to take appropriate action. So typically, payroll clearing account is nothing just like any other clearing account. It's more of a timing differences. Because of that, we some balances here, correct? So this is basically the payroll. I mean the gross payroll, or I mean, yes, mainly the gross payroll, where we kind of see it posted here, and that gets paid afterwards. So that's the one kind of payroll liability account that we see. Now, I have also seen a different kind of payroll liability account, which is actually the payroll accruals. Typically, we follow this practice where whenever we make any accrual entries for the payroll, we don't really we don't merge it with the typical payroll clearing or payroll liability account. We actually keep it separate, because then we can easily keep track of it. Because if we then keep merging it with this account, it becomes then very difficult to reconcile. Because when we then look at the payroll liability account, you have your routine payrolls, and then you also have your routine payroll accruals, right? So one of the other liability account that we generally maintain is payroll accruals, where all we do, whatever the remaining days of the month for which the payroll is not accrued, we accrue it, and then immediately on the next day we kind of reverse it, right? So this is the practice that we generally follow at the month end close. So every time when we look at that account, we would always expect zero balance, right? So this is a payroll accruals, which I would suggest to have a separate account, and the expectation for that account that we should accrue the payroll, and immediately on the next day we should reverse it out, right? Now, the third account that we see is payroll tax liability. Now, most payroll companies that I have dealt with, like Gusto, ADP, Paychecks, I think what happens is that whatever tax that they collect from us, they also pay it immediately. So the balance in this account should be represented. I mean, it's mainly the recent payroll that should reflect the balance. So whenever we look at the payroll tax payable account, we should again see the same trend. Like there should be the credit entry, and when the payment is made, then there should be the debit entries, correct? So ideally, the balance, the ending balance in this account should be represented by the last payroll, which is supposed to be paid in the next pay period, correct? Now, in this case, again, this is an example. This is a kind of mistake that I have also seen that people have been making. They kind of recording the liabilities correctly in books, but all the payroll tax payments, instead of adjusting towards the liability, they kind of record it as an expense, correct? So this is something we have to keep an eye on. So just like we expect those offsetting balance here, in case of payroll clearing, we should also see the exact same balance, exact same pattern in case of payroll liability, payroll tax liability account as well. All right. So this is another way, like you can keep an eye on payroll tax liability. All right. Now this is not so common, child support and garnishment. But the reason why I have covered today is that a lot of people I have seen that made this mistake, where whenever they kind of, at times you kind of might see in category called child support or garnishment, instead of recording it as a separate liability account, people might just merge with the payroll tax liability. It is actually not a payroll tax liability. It's a separate payment. At times, the like government is asked employer to deduct it from the employee's payroll, and then eventually it gets paid to that particular authority, right? So it is advisable not to merge any of these accounts with any of like payroll liability or payroll tax liability. It is advisable to have a separate account, child support or garnishment, and then accordingly the payment should also be adjusted towards that, right? So again, if whenever you see any kind of category in your payroll report, we should have a separate account, and then also keep an eye on all those payments which are made towards this liability should be recorded to this account, right? So overall, the concept of payroll liability is not that complicated at all once we know how the payroll is being recorded, right? So these are the things that we have to keep an eye on payroll liability account. So just to summarize, whenever we are looking at balance sheet, like if I'm looking at this balance sheet as of December 2022, I would expect that whatever balance I'm showing here should actually be paid in the next pay period, right? That is how we should make sure that this balance are showing the accurate picture. So this is more about the payroll. Now let's talk about the equity. Now equity is something lot of, again, this is again from my experience, a lot of people don't pay attention to that much because it's not so common. Now, one of the most common mistake that I have seen is this account called opening balance equity. Now, technically, I mean, this account should not even exist, right? But the most clients that I have personally worked on, I've found that there's an account called opening balance equity. Now, I have seen that people have been using this account, especially when they are, let's say, booking some opening adjustments. Let's say they kind of adding a credit card account or bank account or any sort of asset account. They kind of add this account, and like they just use this like as a clearing account adjustment. So whenever they want to book something, the other side, they're going to be using it, right? But technically there should not be any such accounts exist ever in the books, right? So let us first of all try to understand what are the different equity accounts that should exist. Now it all depends on the type of entity that the business is of, right? Now, if it is corporation, you got different chart of accounts with equity. Even there's a different treatment of the different transactions. If it is partnership firms, you got to have different chart of accounts and different transactions recorded that way. If it is S corporation, then you also have a different chart of account. So depending upon the type of entity that the business is, you need to have a proper equity structure in place. All right. So let's just talk about what are those different entities and how the chart of account should be structured. I'm going to take you back to an Excel file where we're going to talking about this. So, okay, corporation, these are the most common ones. I mean, obviously there is non-profit and others, but I'm not going to touch base on that. So let's just talk about these 4 types of different entity types and how should we set up the chart of accounts for that. So as I kind of showed you that in any case, we should not literally see opening balance equity account, and that's why I have turned it into red. Okay, so that's that. Now, in case of corporation, we should have a common stock. We should have additional paid in capital, dividend distribution, and the retained earning and the net income. Right now, this is a corporation is an entity type that is the one that actually pays taxes, right? So when I say this kind of corporation pays taxes, what I mean by that is that whatever profits that they are making, the business itself is supposed to be paying taxes to the government, right? And the reason why I'm telling you this is also because there are different treatment, also a different chart of accounts that we also need to set up when the entity is actually corporation, right? So in case of corporation, corporation will be paying income tax at the federal level and at the state level as well. And whenever those tax payments are made, we also need to make sure that we book those expenses accordingly in the profit and loss account also, correct? So income tax should actually be created as other expense because it's not a typical business expense. So we should not be recording it as a normal operating expense. It should be created below, like after total expenses, there's other expense and they should be recorded there. It's a tax paying entity, which means the entity itself is a taxable, and that's why they need to pay the taxes. In case of corporation, it is very much important that the any payments that is made to officers, right, should be shown separately, like officer compensation or any sort of insurance or life insurance that is paid on behalf of officer. Those payments should be listed separately on profit and loss account, because there is a like a need whenever the taxes need to be filed. There is a need to show this information separately, and that's why it's quite important. Now, in case of S corporation, the profit and the equity structure is more or less remains same, but the main thing here is that this S corporation is not supposed to be paying any taxes, right? The taxes are actually passed through to the individual shareholders, and that's why there is no taxes to be paid in case of S corporation. So what happens in this case is that whatever profit or loss is made in this type of entity, there is one adjustment that is generally made. So whatever is there in return earning actually gets I would say offset, or not offset, but moved towards the equity account, shareholder distribution account, right? So we generally don't expect any return earning to carry forward. That gets moved to the shareholder distribution account. All right, so that's one of the thing that we have to keep an eye whenever we are dealing with S corporation. Now, obviously, there is no income tax, so we don't have to worry about it. Now, I have seen some, I would say, situations where there are some states that might ask you to pay minimum state tax, right? It's like even though you're not taxable entity, but it's a state requirements that they ask you to pay some minimum income tax. So again, that should be listed as expense on profit and loss side. Just like corporation, we also need to show officer compensation or any related expenses separately on the profit and loss accounts. All right. So that's about corporation, S corporation. With the partnership, it's pretty straightforward. Like you need to have a different now. Okay, one more thing to be noted here is that I have also seen that a lot of people actually merge different partners' capital accounts and draws accounts into kind of like together. So it's very, very important to have a separate account, separate equity or separate capital or separate draw account for each partner, so that we can clearly see the distributions between both these partners, right? So again, partnership is not a taxable entity. Whatever income or losses are done, it gets flowed through the partner's account, and like partners would report it when they are filing their own taxes, right? So similar to S corporation, they do not have return earning. Whatever profits or losses they're making eventually gets transferred to partner A and partner B. So the way when I say it gets transferred, like if I just show you literally, it's like imagine if we are, let's say, looking at balance sheet for January 2023, like in this particular case, let's say if I'm looking at January 2023, I would not expect any return earning, because we make an adjustment where we actually pass on the balance, or we kind of nullify this account return earning and then pass it to the different partners capital account. All right, so this is the thing with the partnership. Now, in case of partnership, they don't literally call it salary, they call it guaranteed payments. And that's why the terminology that obviously it's not going to make a huge difference, but it's like this is the terminology that they use, called guaranteed payments. And that's how we should have set up the chart of accounts on profit and loss. And okay, so these are the things that we have to keep an eye when it is the partnership firm. Schedule C is pretty straightforward. We just need to have owner's capital, owner's draw, return earning, net income. Typically, we have seen that there is no as such payments being drawn in form of salary. The owner withdraws whenever they need, and that's how there is nothing like a separate. If it is salary, they kind of book it. Then we just need to show it as owner's salary on profit and loss. Otherwise, the structure is pretty straightforward, like owner's capital and owner's draw. Okay. So this is pretty much important thing when it comes to setting up the equity structure for any sort of businesses, because it all depends on what kind of entity it is. And once we have set up the structure, it is also quite important to have these accounts, and also the transactions that I was just speaking about, like the pass-through transactions, or like the income tax transactions should be handled accordingly. All right. So this is about the equity. One other thing I kind of keep an eye whenever I'm looking at equity is that what is the addition? Like, let's say, imagine if there were additional capital introduced, or there were, let's say, partner introduced some more capital, because at times it is not so common transaction. So whenever you see any changes in the equity account, we should always look at the transactions as to whether it is a capital or whether it's a temporary loan that someone has provided, right? So at least it's a I would say it's kind of important to understand what new transactions have been coded as additional paid-in capital or common stock, and that's how it should be reviewed. Same way, especially with the drawing or shareholder distribution account, we need to review the transactions to see, are these really distributions, are these really owner's draw, right? At times people, it is also possible that the transactions may have been recorded as owner's draw, but appears like it could be actually the business transaction. So this is one thing that we generally check every month. Whenever any transactions or any changes made to equity accounts, it could be any accounts, we actually review them and make sure that these are legitimate and these are not incorrectly coded, right? Because again, this is one thing I have also seen, that people generally leave this section assuming that they're going to be taking care at the year end, or someone who files the taxes will take care at the year end. So this is, I would say, the most overlooked section that people don't pay attention to, but I would say it's the most important thing that we have to pay attention to whenever we review the financials. All right, so that's equity. Now if we look at it, like, we literally went from bank accounts, account receivable, current assets, fixed assets. So as we kind of start reviewing, and kind of as we finish reviewing these accounts, our goal would always be to make sure that the ending balance should actually be accurate, right? So this should be, I mean, this is actually pretty much important, that we have accurate ending balances here, so that we have a good base for the next year. So this, like, as long as we kind of follow this kind of guidelines for every balance sheet accounts, it will automatically mean that all of your balance sheet account would start showing the accurate picture. So this is how we should be reviewing balance sheet accounts. Now, let us talk about what to keep an eye when we review the profit and loss accounts, okay? So I do have some information in Excel. I kind of thought that would be easier to put it this way. So kind of we can look at the profit and loss, and we can also look at the points to keep an eye on, right? Now, whenever we are reviewing profit and loss accounts, the most important thing is that we actually understand what the business is doing, right? And that is how we can make sure that we can review it correctly, right? If we know what this business is doing, how the revenue is flowing through, is it coming from by invoicing customers, is it coming from POS, or is it coming from any billing systems, right? So once we know what the business is doing, how the revenue and how the different expenses are being recorded, that's how we can kind of review profit and loss accurately, right? Now this is just a simple extract that I have taken from one of the sample file, right? The way we actually start looking at profit and loss is the income. Now in case of income, it all drills down to how the income has been recorded. Now again, it all depends on what kind of business it is. If it is more of a retail businesses, most likely the income is coming from POS. If it is more of a professional services, like accountants, I mean, you would expect that there are monthly invoices which are created to customers, to clients, and that's how the revenue is being recorded. Now, depending upon how the invoice, I mean, how the revenue is recorded, we need to review it accordingly. So if I see that this is, let's say if I'm looking at this revenue, and if I see all the different customer invoices are being recorded, what I would make sure is that I would not expect any sort of deposits, bank deposits, being recorded to this account, or I would not expect any sales receipts recorded to this account. Because if we are recording invoices, and if we then also book the deposits, that might mean that we kind of double booking the revenue, right? So this is one checkpoint that I always check, depending upon how the revenue is being recorded. So if we kind of creating invoices, I would not expect any cash deposits directly coded to this account, right? Now, imagine if we are recording, let's say, revenue from Shopify or any sort of third-party billing system, we can easily reconcile it. So the one thing that we would do is that we make sure that whatever revenue that we have recorded here, and then if you have some source system where the revenue is being recorded, it's advisable to reconcile your revenue numbers matches with both the systems, right? Another way we have seen where revenue, how revenue is being recorded is directly from the bank deposits. So we have seen that the Stripe deposits or the Shopify deposits or Amazon deposits are directly booked as revenue. Now, if that is how the revenue is being recorded, we kind of keep an eye on two things, because whenever this kind of deposits being recorded to sales directly, most likely the sales gonna be underrated, right, or overrated in some cases. So number one, in this case, the deposits that we are recording here could also include the sales tax that we may have collected, right? In this case, if that is the case, we actually make some adjustments to take out the sales tax out of this revenue and then put it on balance sheet. Okay, so that's one thing that we keep an eye on. Second thing, especially with the merchant deposits like Stripe or Square, what they do is that whenever they are making or kind of depositing money to our bank account, they deduct some sort of fees out of those settlements, like the batches that they are kind of depositing. Now, if that is the case, that means we are under recording the sales. Now, in this case, we have to kind of increase the sales and debit the expense for the merchant fees, right? So that is why I said that it all drills down to what kind of business it is, how the revenue is being recorded, and that's how we need to make some of the adjustments that I just spoke about, right? So especially in case of the cash, I would say, in case of businesses where the sales is directly being recorded based on the bank deposits, we have to keep an eye that it should not include sales tax, it should not include any sort of fees, and we should kind of make the adjustments if that is the case, right? So that's what we generally keep an eye when we check the revenue. Now, there are typically different issues that we pay attention to whenever we review the profit and loss accounts. Number one is we kind of keep an eye on chart of account issues. See, sometimes it may not really matter because some accounts may not really impact the bottom line. Your bottom line might remain the same, but it's not the fair representation of your profit and loss statement. So, for example, this is the most common mistake that we have seen, like people have interest income account here. Now, this is not a business income, and this account should not stay here. We should have this account as other income, right? So again, these are a kind of chart of account issues that we have to keep an eye whenever we are reviewing the profit and loss statement, right? A third thing is the GL misclassification. Now, GL misclassification is something like obviously some transactions got posted incorrectly to some other account. So again, I would say that the best way I generally use this is that we have this report called review expenses, which is kind of pretty, I would say, because typically what we do, we go into one account and then look at the long list of transactions and then try to find out if something is miscoded. So instead, I kind of quickly look at this report. It says review expenses by vendor. So I simply scroll down and see if something is miscoded. Like imagine, let me just show. So imagine if one vendor is coded to this account and then also to this account, then those are the kind of possible misclassifications, and we need to make sure that we fix it, right? So this is like either if you are using Xenett, you can simply do it this way, or if you are in QuickBooks or whatever other accounting software that you guys are using, then another option is to open the GL and do the basically the GL scrutiny. One another way that I do, I quickly scan through this, the by GL. So what this tells me is that for every single account, I can see a summarized version, right? If I open this account, let's say in QuickBooks or in a whatever accounting software, I might see long list of transactions, which I don't always have to see it. Instead, I would just see this summarized version. So like advertising, I mean, what is ADP doing here, or what is Amazon doing here, right? So I kind of spend few minutes, quickly go through what each account has in it, and accordingly we make the fixes as it asks for, right? So this is what I do to ensure that nothing is misclassified. All right. All right, I'm going to take a pause. Just going to quickly check and see if there is anything that I need to address in the chat. So guys, feel free to also share something if you think that you guys are following, or if I'm not covering, so feel free to mention that. Right? I don't see any questions in the chat, so I believe we are good to go. All right. Third thing is the consistency review. Okay. Now, consistency review. So this is one way I look at the profit and loss, is obviously by comparing the current year with the previous year, and then we just do a fair check whether things look overall okay or not, right? So this way, I mean, if something is literally off, then you can find out, I mean, you can obviously go into account like what's wrong in there, and kind of you can then take appropriate action. So in this case, for example, this one, I might just open the account and see what transactions are there, what transactions are not here. If that means that there are some yearly transactions that are not there, is it something that we should be accruing, right? So those kind of adjustments that we should keep an eye, and we need to make those adjustments, right? Now with the GL misclassification, one of the issues I have always encountered is that people actually kind of get confused with the late payment charges with the credit card, or interest charges for the credit card with the bank fees. This is the practice that we generally follow. We keep actually the bank charges separately, and if someone is doing late payment or is paying some sort of interest, we kind of show it differently, correct? So we should not really be merging it for the better representation. So if that is the case, then we have to just kind of show it separately. This is something entry posted to parent account. So again, we also have it in Xenett. So this is the quickest way. We kind of look at all those transactions that are posted to parent accounts, and then we reclassify it. So I think these are the checkpoints that if we are resolving them on a routine basis, like every month, we don't have to deal with this kind of issues for the year end. So for example, this one, I mean, we already have some accounts. There is no point of having transactions here at these accounts. Okay, so that's another thing that we keep an eye on. Now, obviously, any negative amounts that we see on profit and loss should always be investigated and find out why it's negative. Now, I mean, if it is more of a refunds account or discount account, I mean, obviously you would always expect the negative amounts. But other than that, if you see anything is negative, then we need to find out why it's negative, and depending upon the case, we need to take appropriate actions. All right. So that's another thing that we have to keep an eye. This is something I also check is personal expenses. Now, especially with the partnership or the Schedule C clients, sole proprietors, oftentimes we've seen that the personal expenses actually get booked as business expenses. So, for example, um, we have seen that charges like YouTube subscriptions or Apple subscriptions, right? Or some of the apps subscriptions, which are generally used in phone, getting booked as profit and loss as a business expense account, right? So we have to keep an eye whenever we are recording any such expenses that if it is personal, we should not be booking here. Rather, it should be routed through the balance sheet accounts, right? That's that. Obviously, uncategorized entries, we would not expect it at any point of time. So if there is anything that we see uncategorized, we need to look at it and we need to obviously resolve it. Expenses that can be capitalized or made prepaid. Now, there are certain accounts that we check in specific, right? So if I see accounts like repairs, if I see accounts like tools or equipments, right? If it shows some larger amounts, would just look into it and find out that what kind of transactions are being recorded into that. If the transactions amounts are quite material, then we need to then think of capitalizing that. So what we also do, we kind of just created a view here that anytime there are expenses over 2.5k, I would want to see them. And then if I see the amounts are quite material, I might just decide and put them to, I might just capitalize them, right? So this is a one thing that we keep an eye whenever we review profit and loss account. Keep an eye on some of the larger transactions, and then you can decide whether you want to capitalize it or not, right? Same way, if I see some transactions like, so what I've done here is that there are certain accounts that I have picked, like for example, especially this is the case with the software subscriptions where at times we end up paying charges in the advance for the full year, right? And again, with that, we kind of set up some threshold. It could be $500, $1,000, $2,000, depending on the size of client. So if I see, let's say, some transactions is kind of bigger amounts like Salesforce or Microsoft, if it is paid in advance for the full year, then we need to make prepared adjustments for the same. So we typically, what I've done is that I've selected certain accounts like software subscriptions or advertising or rent or insurances. And if we see any amounts in there, we specifically keep an eye that it's not for the multiple periods. And then if it is, then we have to make sure that we make the prepaid adjustments accordingly. All right. So this is one thing that we also keep an eye with this kind of accounts. All right. Now, in case of corporation, which we already touched base on, like, okay, I kind of intentionally put this. So this is like a most, I would say, these two actually. And I would say, I mean, people generally don't. I've seen that like they just literally put the transactions whenever they feel like it's tax or it's sales tax, right? First of all, let's talk about sales tax. Sales tax is not an expense at all. So what we have seen is that when people are recording those deposits here, this sales, so imagine all the bank deposits that we are getting from Stripe or merchants are getting booked here, and it also has sales tax in it. Because the sales tax is not recorded separately as liability, and when the sales tax payments are done, they kind of book it here, right? In here. Now, obviously, the net income, it's not going to be impacted because it's getting nullified. But again, this is not the right way to showcase your revenue, because in this case, this includes sales tax, which means your sales is inflated, and this is not your expense, this is your liability, right? So anytime if we see an account like sales tax, we need to make sure that this account should not exist ever in the profit and loss. Okay. Similarly, taxes and licenses is like a very, I would say, um, generic account. We should not have it like that, because we have seen that anytime people see that if it's a payment made to any government authority, they will just put it here, right? But you have to understand what different kinds of taxes that the company is paying, right? Because it all depends. I mean, there's some certain taxes which are specific to businesses. For example, if it is restaurant, you end up paying some liquor taxes, right? If it is corporation, this might include income tax. And if that is the case, income tax should actually be listed here somewhere in other expenses, right? So anytime, and by the way, this is also one account that the CPAs or whoever is filing the taxes will always have a look at it to see what kind of transactions are recorded in this account, right? So this is something, these accounts needs to be thoroughly reviewed and make sure that, because sometimes we've also seen that um, some, I mean, we also do pay annual filing fees. Rather than having a separate account for that, people just club it here, right? So again, we have to make sure that what are the transactions recorded in this account, and those transactions should be classified accordingly. All right. That's that. With the payroll, there are a few things we have to keep an eye with the payroll. Obviously, number one is depending upon, and this also will include the chart of accounts thing that I was talking about. Depending upon the type of entity, we need to make sure that we have the right accounts set up here, right? So, for example, if it is corporation, we should not just book all the expenses under payroll expenses, right? If this includes any sort of officer's compensation, right, there should be a separate account for that to record that. And again, this is not gonna throw your numbers off. Same thing, it's not gonna make your net income inaccurate or things like that. But again, this is not how it should be handled. There is a separate account meant to be for that, and those accounts should be created separately, and that is where it needs to be booked, right? So that's one thing that you have to keep an eye with the chart of accounts when it comes to payroll. Another thing is the payroll taxes here. Somewhere is employer tax. I would say we should just call it payroll taxes. One thing we also have to keep an eye here is that we have seen that people just sometimes book payments, like whatever tax payments that are going out from the bank account, just booking it. They just book it here, right? But that is not how it should be handled, because whatever payment is going out from the bank account, it actually includes some portion of employer and some portion of employee, right? So we need to make sure that this only should include the employer's portion, not the employee portion, right? So again, it all boils down to how we are recording the payroll. All I'm trying to make a point here is that this should actually match with your payroll reports. Whatever your employer tax liability is listed on your payroll reports should match with this. In fact, one reconciliation that we also do at the end of the year is we reconcile this with the different payroll forms. So we kind of reconcile this with payroll 940, 941, and then also W2s. We kind of reconcile the gross payroll as well, right? So that's generally typically the exercise that we do, because this has been the most, I would say, requested thing from the CPAs that we have been working with. So we always prepare the reconciliation to reconcile. This is what has been reported in this payroll forms 940, 941, and this is what is recorded in books, and that's how we reconcile it, right? So that's another exercise that we also do. All right, that's that. Then what we also do, especially with the payroll accruals, I mean, this can also be taken care when we are reviewing balance sheet accounts, but this is something, if the payroll is off, we also make sure that proper accruals has been made so that it looks consistent with the previous year or previous month, right? So we need to make sure, not just with the payroll, but any sort of expenses that we are reviewing with the profit and loss, if something is missing, right, then we have to make sure that if whether the expense is not there at all, or are we really missing to book that expense. And accordingly, we need to make sure that we book the proper accrual entries for the same. All right. So that's that. Um, all right. So just want to make sure I'm not kind of missing out on any of the points. So these are the most common ones that we keep an eye while reviewing profit and loss. But as I mentioned, I mean, it all depends on the type of business that we are dealing with. And each business is different and their expenses would be different. The best way, and this is what we tell our people, that we need to set some expectation for every single account. Like, what should I expect here, or what should I expect here, right? So for example, automobile, my expectation is that anything that is related to automobile repairs, I would expect it here, right? Now, one of the mistake that we have also seen, that with this kind of expense account, people also book the travel expenses with this because they feel like it's something related to car. They would just put it here, right? So things like this we need to make sure that we pay attention to. Similarly, there are some identical accounts or some generic accounts which we should not expect, like other business expense account. I would say, I mean, I would not want to ever have accounts like other business accounts or general expenses or miscellaneous expenses, because then it will always leave a room for anything being misclassified, right? So we'll try to have as much accurate accounts as we have on chart of accounts. And then if we don't find something, we typically then use office supplies or office expense account, right? But at least I would not expect this kind of accounts ever in my profit and loss. All right. So that's pretty much it that I would generally, yeah. I mean, this all would cover in chart of account issues. So I'm not gonna, so like electricity, I would rather move it from there, put it here under utilities, right? So that's that. Um, all right, so that's pretty much it with the what we do with the profit and loss account, guys. I would just ask anyone if you wanted to like ask any questions in the chat or unmute yourself, talk about it, share your experience. If you do things differently, I mean, it's just the open floor right now. Uh, I mean, I like, from my end, we have covered the whole thing with the profit and loss and balance sheet and everything. So, and one more thing that we typically do once we do with the review is we actually create the working papers. Like, we literally have balance sheet, profit and loss, and then for every balance sheet accounts, we have a working papers that supports the. I think we talked about it before that. For every single balance sheet accounts, we ask our people to attach working papers, right? So whoever is looking at this, they would kind of, if they at all have any questions on any of the accounts, they would either see some sort of review note, or they would either see some sort of working papers attached right here, right? So that way, it just avoids unnecessary questions. All right, guys. So this is it from my end when it comes to year-end close checklist. We will certainly be sharing any, I mean, and not any, but all the resources that we have. Oh yes, guys. I mean, unfortunately, the part one recording did not get, I would say, recorded correctly. So what I'll be doing is that whatever we have covered in the part one, we will be recording it separately and we'll give it to you guys. So part two is done, part three is done. But for the part one, whatever topics that we have covered, we'll just be recording a separate session for that and we'll share it with you guys. All right. And we also have a year-end checklist. I mean, okay. Along with this recording that we will be sharing with you, we'll also be sharing all the resources, the checklist that we follow to you guys, and you can then always use this to customize it for your clients. Feel free, guys, if you have any thing that you would want to share or you want to ask. Thank you, Beth. Thank you for attending this. I hope you found this helpful. With this close process already, yes, Darlena, it's already exists in form of template. So we don't really push it to your clients because each client is different. But then at the template level, you can make changes, and then you can also import it to your client and then also make changes. And then, yep, that will then, it's a one-time thing. You have to just import it for your client, and that's it. You should be all good. And if you need any help with that, we can also help you with that. All right, guys, I think we look like all set here. So thank you very much for all those who attended this. I hope you guys found this helpful. We'll be sharing all the resources with this. I mean, after this webinar, not literally after this webinar, but in a day or two. If you guys have any questions, feel free to reach out, and we'll be more than happy to answer any questions that you guys may have. Thank you very much, and we'll talk soon. Take care, guys.